Well, good afternoon, everybody. It's Tuesday in Houston, Texas, and we've discovered a fantastic bench of people to talk to you about the number one issue in oil and gas today, and that's capital. I just had a lunch with a good friend, and we referred to it as capital starvation. But what all of us are asking in oil and gas is, where is the money going to come from? And so we're really lucky that we've got some great friends and some great folks internally to call on to try to answer that question. In just a minute, I'll go to Mike Bradley and Colin Fenton, and we'll run down some of the usual and some of the pregame for today. But let me introduce our group, because we've got a big one, because this is a rough issue, and we needed big brains and good friends to help us tackle this one. You're first going to hear from Arthur Long and Shala Pritchard from Gibson Dunn. They've done some work looking at what's going on. It's called the Fair Access to Capital proposal, and it's fascinating, and it has important implications for energy, and they're going to walk us through their analysis of that. We're also joined by two great friends from the convert market and from the private capital market, Jason Wood from J. Wood Capital and Chris Abbott from Riverstone. And so they're going to take us on a tour of those two areas of the world. Our own Kevin Lockhart is with us from Capital Markets Advisory, and he'll talk a little bit about what energy companies are finding, particularly in the public debt markets. And then no discussion of anything like these topics would be complete without a little ESG. And so Craig Webster, our own head of sustainability, is going to touch on a couple of issues he's been noticing. So it is action-packed. We should call this is like cafeteria. We've got all the flavors lined up, the Capital Cafeteria, and we'll walk you guys all through it. Mike, why don't you kick us off and tell us a couple of things about what's happening on the screen and whatever you think would help us get warm for today.
You know, last week when we were sitting here doing this video, we were talking about OPEC and OPEC not having a deal done. There was concern in the markets. Crude oil was a little bit choppy, and we now have a deal. 500,000 barrel raise at the beginning of the year, and then they will be checking it out subsequently every month. But crude oil is stabilized, and so that's a good thing. The thing I wanted to point to here is, you know, obviously the S&P energy sector has done well here. It's over the last week, it's up substantially. It's outperformed. You know, the market is up pretty well, pretty good as well. It's massively outperformed every other sector, and as you can see here, the energy index is up as well, and the dollar is continued to be going down. And on our next slide, one of the things that we wanted to show here was it's pretty busy, but we wanted to show the dollar, which is a white line down here. It's been going down. And if you look at Bitcoin, which is a red line, and the purple line, which is base metals, they've been going to the moon. And the blue line is crude oil. It's gone up, but it really hasn't gone up materially, and which leads us to our next slide. And this is a slide that, you know, guys like Jeffrey Gundlach look at a double line, and this is sort of copper gold, which is the white line, and 10-year government bonds, which is a blue line. And you can tell over time they tend to move together. And so what this tells you is that either copper has gone too far, which is, you know, probably can be said for most base metals. Gold has come down here over the last couple months, so that's why the ratio has gone up. Or, you know, government bonds down here are basically going to be going up a lot over the next 6, 9, 12 months. And I think what we say is that we think the latter is going to happen. We think that what you're seeing in base metals, what you're seeing in just a lot of the market's already anticipating, the equity markets are anticipating demand is going to be picking up. And so how does that play into our thought? We think the dollar is going to continue to get weaker. We think that the bonds are probably going to come up in price. This gap is going to fill right here, and this is going to be a good thing for energy. Typically energy, industrial commodities, they tend to run with a weakening dollar. As the economies start to come back and snap back, we think there's more room to run. In energy in particular, we think there's a lot more room to run. And so, that's kind of where we are right now. What does it mean for the energy stocks? As you've seen in the last, 3, 4, 5, 6 months, the market has opened up a little bit from a debt standpoint. But what we think is going to happen, if we do think rates are going to be coming up over the next, 2021, I think that's a market where if you're looking to, access capital, it's probably going to be about as cheap as you can get it right now. And so energy equities, especially on the convert side, it may be something, a viable option to look at this point in time. And Jason will talk about that later. But, the group has come off 25, 30% from the bottom. But, we showed this chart right here to just say if oil just got back up to $50, this 12-month strip, you're talking about another 45 to 50% upside from here. And a lot of these convert strategies, you can go ahead and then dial that into the convert strategy. So, I think that's a viable option right now. So if you are basically an energy company and you do think that inflation is going to be hitting like we do next year, and bond prices probably going to be going up next year, might not be a bad time now to be thinking about refinancing or maybe looking at a convert option.
All right, great. Thanks, Mike. Colin, what would you tell us today?
Yes, sir. Well, picking up on Mike's point about that asynchronicity between the consumption cycle and the investment cycle, we have proof from another market, crude oil, if we can bring up this slide, that proves that risk has changed. And in particular, you'll be familiar with this slide where we take the term structure of the WTI futures market on the horizontal axis, realized oil price volatility on the Y. We've already talked for a while that we've exited that red box. The red box is bad, high volatility and a contango structure, meaning that the prompt price is significantly below the forward price. The most recent dot, the end of week, December 4, is now in the green zone. And it's the first time since January 31st, 2020, that we've had an observation here. Now, it's probably too early to call this movement into a post-COVID regime. It's possible that we go back to the left-hand side of that zero line. But what's critically important to understand here is it's not that the forward price is falling that's causing this. We see both the prompt price and the forward prices rising. And so the core conclusion is that demand in the present exceeds supply. We're beginning to see some empirical proof that there is a supply gap because CapEx, particularly in the OECD countries, is below where it needs to be. And if that dot continues to move to the right, it means this industry is not getting enough capital.
That's great, Colin. Colin, would you mind? There's a lot going on in this chart, but just basic takeaways. The commodity is not as volatile. It's much less volatile than it has been. And obviously forward prices have risen, it's trying to pull money back into the business. And so all of that stuff in the southeast corner of this box is good stuff for all of us.
Yeah, and I make one other point on it. You see the sort of navy color observations? That's when you had the shale investment. So it was a lot of capital depressing volatility, but only giving you kind of modestly bullish numbers. If you look all the way to the right, you see those green observations. That's more from the early 2000 period where you had a true supply-demand gap and a call on capital. And so one other important point to know is that this is every single weekly observation back to 1983. So you're looking at 40,000 feet, everything that's happened going on for almost 4 decades.
And so those early 2000s numbers, Colin, do you happen to remember what some of those were, the near month versus the forward curve? Like, it's obviously the percentages were pretty big.
Yeah, you can see there that the percentages get to be about 40% backwardated or more. Usually 60% is a boundary condition on this version of what traders call a volatility smile. It's not technically a volatility smile, but it's kind of related to one. And what's important to understand is that when we got to the 2003 to 2008 period, it was the back end of the curve that led the prompts. So the 5-year forward in the year 2003, 2004 was the really important price to watch as it was climbing toward the true marginal cost of production. If we continue to starve this industry of capital, but demand hydrocarbons for medical equipment, iPhones, and all the other stuff that are not fossil fuels, then what will happen is we will repeat history and we will go far to the right, and humanity will get a very signal lesson in exactly what its demand for hydrocarbons is.
Well, let's jump in right with our guests because we've got a bunch of fantastic guests. We're going to start with Arthur and Shala from Gibson Dunn. They've done some analysis and have a presentation around this fair access to capital provision. I think we at TPH have been lucky to already see this, and I can speak for all of us and tell you it's fascinating stuff. So, Arthur, why don't I turn it over to the two of you to walk us through?
Terrific. So this is Arthur Long. I'm a co-chair of the Financial Institutions Group at Gibson, Dunn and Crutcher in New York, and I'm joined by my partner Shella Pritchard, who is an expert on energy finance from our Houston office. And what we'll be talking about today is a quite an interesting proposed rule that came out of one of the main bank regulators in Washington, the Office of the Comptroller of the Currency, which is the regulator for national banks. So all the money center banks, J.P. Morgan, Citi, Bank of America, Wells Fargo, are regulated by the OCC. PNC is a national bank, and this is quite interesting in that it is one of rare times that it looks like the regulators are sort of wading into what could be called a bit of a political issue with respect to capital and lending. And I'll be talking about that. But I think in order to set the stage, we'll start with Shalla, who'll give us a few, background on where energy financing is right now.
Yeah, thank you, Arthur. So, this slide is called No New Normal, because really we have not really recovered yet, even from the 2016 downturn. And that's where a lot of us are familiar with the OCC's leveraged lending guidelines that fundamentally changed how reserve-based loans to E&P companies are underwritten, and was the first step in constraining capital to upstream companies. In addition, since then, a lot of banks, for various reasons, have either curtailed lending in the upstream space or just exited the space completely. And bank consolidations are further limiting commitments to energy companies. On top of that, everyone's favorite topic, ESG, companies are facing increasing pressure from investors, but so are financial institutions. Amidst all of this, the OCC fair access proposal that Arthur will go into could be one bright side for upstream companies in protecting access to capital. But the future of the proposal is in doubt, as Arthur will discuss. So Arthur, I'll turn it over to you.
Okay, great. Thank you very much. And maybe the best way to start with this is to go back about 8 years to something that is probably not well known to people in this space, but it was a somewhat controversial operation, as it was called, by the Justice Department at the time, which also roped in one of the bank regulators, the Federal Deposit Insurance Corporation, and raised real concerns that regulators were pressuring banks to cut themselves off from certain customers. The operation was called Choke Point, and initially it was raised because of concerns about basically consumer fraud. But as it got going, it appeared that the FDIC, which is principally the regulator of smaller banks, state chartered banks, was actually, some of the staff were discouraging the banks they regulated from lending to what are basically consumer finance lenders or payday lenders. The issue became both the subject of congressional interest as well as litigation by some of the payday lenders themselves, who were basically saying, "Look, we're conducting a perfectly legal business. We lend to people who can't otherwise get credit, and therefore we price our credit accordingly." And there is no reason, even if the FDIC doesn't particularly like our businesses, they have no valid reason for telling the banks they regulate not to lend to us. And as noted in the slide, the Congress got involved, and in the lawsuit, discovery by the plaintiff payday lawyers showed that some of the FDIC personnel were themselves not following their internal policies, and there was some suggestion that they actually had improperly influenced regulated banks not to lend to these companies. The litigation was settled in 2019, but it was for people who follow the banking industry, it was quite controversial. Certainly the first time, I've been practicing for about 25 years now, and really was the first time that you felt there was a concerted effort for debanking or restricting access to bank products for a lawful business. So with that background, and all of this was referred to in the proposal by the bank regulator. The additional background was apparently in June of this year, congressmen and senators from Alaska sent a letter to the OCC about apparently the decision by 5 of the nation's largest banks to stop lending to oil and gas projects in the Arctic. Now, obviously, anyone who's followed the Arctic drilling over the last decades knows that's quite controversial. But as with Operation Choke Point, there was no suggestion that these projects were legal. They were, and there was no reason that one could think of, at least as far as the Alaska representatives were concerned, that lending should be constrained, other than perhaps that these were sort of unpopular projects. But it is interesting because the letter did point out, significant banks and an apparent denial. And indeed, the letter goes further and suggests that there may be some internal policies that projects that don't necessarily comply with the Paris Accords might not receive financing. So the bank regulator got this letter in June, and at the same time, it's probably, before we get into actually what the regulator has done as a reaction, it's probably wise to mention both at the New York level, and New York charters a number of significant banks, including Goldman Sachs and Bank of New York Mellon. There is a new focus on climate change as a banking issue, which in itself is a little bit interesting, at least for someone who thinks about what bank regulators normally think about. Now, the New York Department of Financial Services is sort of a first step, but what they are beginning to do is, as regulators generally do, is to focus on financial risks. But you'll note that they have mentioned that the bank should integrate financial risks from climate change into their governance framework, risk management processes, and business strategies, which means that whenever a regulator suggests something like this, obviously this does raise the cost of business in that area, because you have to have more controls, you have to have more governance, you have to have more people thinking about what really the risks are. And climate change obviously is quite broad, so it could cover any number of things, such as lending to real estate where near the oceans, could cover obviously oil and gas lending, carbon lending, but it is could be quite a wide swath of industries could be affected if, in fact, banks do need to monitor these particular risks more than they do now.
Arthur, can I just ask, the New York State Department of Financial Services, would they regulate basically at some level all of Wall Street because they're New York-based organizations, or what is the purview of New York State's DFS?
Sure. Well, they regulate not all of Wall Street, but they regulate state chartered banks, and importantly, because I think a number of the foreign banks are involved in energy lending as well. State licensed branches of foreign banks. In fact, that is probably their largest constituency these days. So Goldman Sachs, Bank of New York Mellon, but Deutsche Bank, many of the Canadian banks, the French banks, some of the Japanese banks are all, their New York offices are all New York State regulated.
Okay.
And just moving along with the election, the Biden administration will have the ability to replace over time many of the federal bank regulators, and therefore set policy with respect to regulatory priorities at those agencies. On reviewing what, some of the campaign materials, you see a similar interest in climate change as in New York, again, from a financial risk perspective. But there are a number of areas where large banks, could be forced to undertake more work in this area just as a risk management matter. Stress testing, after the financial crisis, there are regulatory stress tests, and there are questions of, how do certain portfolios perform under particular stresses? To date, they've primarily been economic, such as a recession or a market crash, but people have suggested climate change there. What is the risk from concentrations in particular industries, and how should particular assets be risk weighted in view of climate change, which is sort of an interesting question, because the risk weighting of assets ties into how much capital a bank will have to hold. So query whether at some point someone will say, because an energy project has these particular risks, we will have to require a bank to maintain more capital against that loan as a similar economically similar loan outside that industry. Now, to do that, there would have to be a regulatory process, notice and comment, so it's not something that can happen overnight. But I think it does bear watching as the new regulators are appointed, what their how they discuss climate change in their regulatory priorities.
So, Arthur, these federal regulatory positions, who would be the key person in the administration who is making the recommendations for those spots? Does it come out of Treasury? Does it come out of the Fed? Does it come directly out of the White House? Do you have a sense of the origins of who will be making those recommendations? Who's the key person in that type of stuff?
Yes, well, there are several. The Treasury Secretary, so Janet Yellen, if she's confirmed, the comptroller of the currency, who basically works in the Treasury, the governors who are appointed to the Fed. It's likely that in late 2020, I think there'll probably be one open seat initially at the Fed, and others may open later in 2021. And then the last one is the FDIC, which we mentioned. So those four: Treasury, Fed, okay, Comptroller, and FDIC.
Okay.
So maybe with that background, and I don't think we have to go through the minutia of it, but probably speaking at a high level of why it is of interest. So November 20th, rule proposal came out from the OCC, which is as I mentioned, is the regulator of the largest banks, and under the general procedures, when there is a new regulation, you put it out in a proposal form with time to comment. But the bottom line, just digging through the minutia, is this proposal probably seeks to head off concerns that the national banks, and in particular large national banks of 100 billion or more, may themselves restrict services to particular disfavored industries. It mentions Operation Choke Point. It mentions the Alaska letter, and the bottom line of it is that the national banks of 100 billion or more would have to make individualized determinations when deciding to extend credit, so that you couldn't shut out or restrict an entire industry, as happened in Choke Point and as the fear from the Alaska letter. It's interesting. The comptroller, Brian Brooks, is he's acting comptroller. He's in sort of his last days. The regulation has a fairly short comment period for people to comment of 45 days. And there is acting comptroller Brooks is quite a well-seasoned lawyer. He was a general counsel at Fannie and Coinbase, the crypto firm, and a partner in O'Melveny and Myers, and also worked alongside Joseph Otting, who was comptroller and ran was affiliated with U.S. Bank. So he's a very seasoned regulatory lawyer. And there is a sense maybe that he is trying to get this done before the incoming administration. But it would actually, as mentioned, it would prohibit banks from basically redlining entire favored industries, as is mentioned in the preamble to the proposal. Then probably the most important part is probably the last part of this bullet. You could consider individualized borrower specific factors when making a decision about extending credit or making loans, but you can't really consider opinions about about the type of business that your customer is in. And it actually is quite revolutionary in that regard. It relies on some language in the Dodd-Frank Act, where it says that the OCC's mission is to make sure that the consumers have fair access to credit. I think that was probably people were probably thinking of a different bunch of consumers, but the statute does use fair access. And it does seem a legitimate interpretation of that to cover disfavored industries.
So, Arthur, are you anticipating? I'm leading the witness, or you're leading me? That was my next question: is reactions. Who's going to show up and say this is a bad idea? And I think you're about to tell us that. Yes.
So, I mean, I think. In terms of bad idea, I'll get to that. In terms of good idea, if you are in an industry where you might have some concerns about that, and certainly fossil fuels is one given recent events, it's great to put in a comment letter supporting the proposal. Interestingly, the large, I mean, it sort of plays out the way you think it might. The Bank Policy Institute, which represents the nation's largest banks, and this proposal focuses on the largest banks. They said that they wanted more information about why the proposal was coming out. The American Bankers Association, which is a little slightly broader group, but also has a lot of large bank constituents, requested the OCC extend the deadline. Republicans were praiseworthy, and environmental groups were not praiseworthy, as one might expect. The banks, it will be interesting to see what their comments. I'm sure they will say that it imposes large burdens and influences their decision making improperly. But it is in some ways. I think it is useful for calling light on the ability of substantial financial institutions to affect whole industries, and I think it is a good proposal to get this out on the table. So, what to expect? As mentioned, all regulations have to have a comment period. This one has 45 days. So, if you want to comment on fears of being cut off from credit, you have until January 4th to do so. And then that's where the politics gets interesting. The comptroller serves at the pleasure of the president, and the president can fire the comptroller for any reason at any time. Not sure, therefore, whether acting comptroller Brooks will actually have a job to go to on January 21st. But 2 weeks is very quick for a final rule to be put in place, but it is possible. If a rule does get in along these lines, there's a federal statute called the Congressional Review Act, which allows Congress to override and basically vacate the rule. But that would depend on the Georgia election. If there is a Republican, if for some reason Brooks does get this done, and there is a Republican majority still in the Senate, I think the rule will stay on the books. But regardless of what happens with this rule, I think participants in the oil and gas industry really do need to be aware that this idea of so-called risk management relating to climate change, which will initially be some form of financial risk management, but could develop further, may very well be a regulatory focus over the next several years. And to that end, what the Alaska delegation did was very effective. And even if the regulatory agencies do go over, actions by representatives, senators, particularly if the Senate doesn't flip, are one way of keeping more consistency in regulation, even if the administrations change as they will.
Hey, Arthur,
yeah.
one more question. I think that there's been some recent press. One of the large banks that's active in the space said, and I'm paraphrasing, of course, so I might get it wrong, but basically we seek to lend to companies that are in compliance with or otherwise striving towards complying with the Paris Accords. Mm-hmm. How would an objective like that get caught up in something like this potentially?
Well, I think that could be problematic under this, because there are that would suggest that there are certain projects or certain companies that might be excluded because they don't fall into that. I can tell you, just to give another example, I go up to one of the banks I do business with, and there's a sign that we proudly saying that it supports a tobacco-free environment. Now, if a national bank of that size had a similar thing about tobacco, I think that could be caught up in that as well. So yeah, I think that could be problematic as too generalized under the proposal, and not having a sufficiently individualized view of each project.
And presumably it wouldn't matter to that calculus whether or not the United States was part of the Paris Accords, or would that be relevant?
It's an interesting question. I think either way, it is likely. It's likely could be an issue. I think if the U.S. came back in, it does strengthen the bank's position. But certainly, as long as the banks are out, as long as the U.S. is out, I think it would be problematic. Another thing, I guess, to note is that if the rule does become final and is not repealed by Congress, you will have new regulators at the OCC administering it, and they could take a more progressive view on the Paris Accord than would currently be the case. So that is also out there.
Well, look, that was fantastic, Arthur and Shala. Thanks for kicking us off with that. It's pretty riveting. As if we weren't watching the Georgia races enough. Here's another race, or another reason to be focused on them. Shala, before we move on, is there anything you would add to that from your clients and what they're going through and what you're hearing from them?
Yeah, I think to reiterate Arthur's point, I think that our clients really should make comments and advocate for something along this line, because again, further constraints on capital at a time like this is just untenable.
What is the best way to do that? Is it literally is there a particular website, or we want to be functional here, tell people where they should send in their comments?
There is. You can address. The rule is public, and you can access it on the OCC website, and it gives a variety of ways to comment, including by email, but you could also send in comments by the old-fashioned way as well. But the way to do it is go to the OCC website, and there will be if you put in fair access rule, it will tell you how to do it.
And maybe last question on this before we move on. I think to Shala's point, and in the oil and gas community, we're all very concerned about access to capital, and so we have every reason to be for this. Are there reasons and implications of this that might not be good, even if they're good for oil and gas? Like, as you watch it, I guess particularly Arthur, with your background, do you see this seems to come from a good spot in terms of why it was put forward, but do you see any concerns on what inadvertently it might trigger?
Well, the one thing I think net to me it is a positive, and you do sometimes have concerns about whether it would lead to excessive supervisory attention by the agencies, thereby putting unnecessary burdens on banks. In other words, the supervisors can come in and annually and say, well, tell me what you're doing about this, give us all your files, and you create almost a little bureaucracy within the bank itself to respond to all this. I think it's, as a matter of principle, I think it's a positive. It really depends on how severe the regulators want to be in enforcing it. But I think net it's a positive development.
Well, in today's world, we just don't have enough government people running around enforcing enough things. So we need more of them, right, Arthur?
This does create work for lawyers, but not everything that is beneficial for lawyers, and including advising people on writing comment letters, which we're happy to do, is beneficial for the common good. But hopefully this will work out in a way that banks will continue to make credit freely available to the industries that need it.
Well, look, I thank you so much. I think what we'll do, we'll attach, if you don't mind, when we blast out the COBT, we'll include your memo.
Mhm.
And we'll also include a link to the OCC website. So if people want to comment, they can comment.
Great.
All right. Well, that's lending land. Now let's go to a highly complex place that nobody better than Jason Wood to navigate, which is the world of converts. I say complex place, Jason, because there's always little features that you can add to get that premium up and to make these pieces of paper really issuer friendly. What would you tell us about the convert market and the ability of oil and gas companies to get some capital from you?
Yeah, hey Maynard. So the convert market is the strongest I've seen in my 27-year career. A lot of that's technical factors. So convert pricing is really good when interest rates are low and equity volatility is reasonably high. And we kind of have the perfect mix of both of those right now. We've seen $93 billion of issuance in the convert market this year. To put that in historic perspective, it's about 3 times the run rate that we've seen since the financial crisis. There's also 2 additional tech deals pricing tonight, Uber and MicroStrategy. So by the end of the year, we could be pushing 100 billion, which isn't as big as Kevin's market on an annual basis, but it's large for converts. So in the energy space, we've seen pricing again continue to get better. There's only been about 3 billion of issuance in energy, but some issuers like Pioneer Natural Resources tapped the market and achieved a 25 basis point coupon, right? So think about that, 25 basis points. So collectively over the 5-year term, they're only paying 1.25 on the funding for 5 years. And as you said, there are kind of different things that we can do to put let's say a call spread on top of it so that there's no dilution until a stock is really doubled or more.
So Jason, if you were, because so many of our good friends in oil and gas land will be watching this with interest, what profile would a high quality issuer have for you in terms of, like, you mentioned like whether it's balance sheet or credit rating or volatility rating or oil gas mix or market cap size? Like, how do you
Sure.
frame up for people generally what a good issuer candidate looks like?
Yeah, so it's really it's just a couple technical things. One, public company, typically a C Corp, $1 billion market cap or bigger, and then ideally that there's some stock borrow. Because as we've talked about in the past, the part of the investor base here are hedged or arbitrage investors who buy the convert and want to short stock simultaneously with the issuance. So really those 3 factors. Now there are some things that'll make it better than others. The bigger the market cap, the better. The higher the equity volatility, combined with the better credit metrics, which of course those 2 tend to be sort of working against each other, but those will all create the sort of best optimal pricing. But bottom line, for most energy issuers, they can get, I should have also added one additional thing, which is the lower the dividend yield, the better as well. Right? Because if the dividend yield is 5-6%, it's tough to make the economics of the convert world work. But overall, I mentioned Pioneer at 25 basis points coupon to up to around 2% is the norm. So somewhere, typically it's south of 1% is oftentimes what can be achieved in the coupons here.
So how should people think at home about their dividend yield versus the convert rate? Is there some kind of ratio, or how would, let's say I had a 2% dividend rate, how would you think about the convert rate?
Yeah, very roughly, the coupon will be about half of the dividend yield or more. So for a company with a dividend yield of 2%, typically the coupon's probably going to be 1% or more.
Okay. Well, gosh, that was easy. I mean, Well, Jason, when you reflect on when, and I've reflected to I neglected to mention that Colin Fenton and Jason were college buddies at Princeton, and so someday on the show we're going to do college stories with Colin and Jason, but we can't squeeze them in today. But as you look back on periods of time when we've had a lot of oil and gas issuance in the convert market, can you think of themes, or was there anything that, does this time look like some of those times? I know that's kind of a hard question, but does this feel like the kind of time we might get more issuance out of the industry?
That's a really good question and hard to answer. I think normally converts are used, particularly when some mix of the high yield market and or the equity markets have indigestion and kind of shut down, right? And so early last year when COVID hit and the high yield market shut, that's when we saw EQT and a couple others turn to the convert market for funding, because the convert market tends to be open the longest when other markets are shut. So I think that's part of it. So if we head into next year, and we talked about politics a little bit before, I think the market is, my 2 cents is the market's priced in the Republican win in Georgia. And I think if the Democrats end up winning there, I think we could see some additional volatility across all of the asset classes. And I think if that happens, again, higher volatility tends to be good for the convert market. And so if there are problems in the markets, particularly the high yield market or the bank market sort of shuts down, I think that's when we'll see the energy companies start to look more closely at converts.
Well, Jason, we're going to have to, you are on a virtual tour of oil and gas country right now, but we're going to have to, we'll probably have to even up the stops for you. Chris, let's jump in with you. You're in private capital, and so ability to be super flexible, custom design, made to order. What would you tell us about oil and gas companies' access to your type of funds and what you're seeing?
Sure, and we're definitely at the other end of the spectrum from Jason's clients. $1 billion market cap is something that I've never seen in our portfolio, but in any event,
you guys are like, this is the perfect show. You're, this is like one of those relationship shows. We're mating you together because you're perfect.
Two ends of the spectrum for sure. But, listen, there's a lot to do for us in the private capital market, just given the amount of exits you see in the traditional banking market. 3 or 4 banks have raised their hand to say that they want to get out of this business altogether. And I think that does create a huge opportunity for capital like mine. But I would tell you that it is certainly not easy going right now to get capital out of private lenders for a bunch of reasons. First, we've got a lot of distress in our own portfolios. So we're working through issues with our existing portfolio companies. And just like any committee that you go to get approval, your committee members say, well, what are you doing about this stuff that you messed up before you put more capital out? Second, all of the pressures that are causing the banks to leave, which include returns and recoveries on their capital, but also ESG pressures, are the same pressures that we face. So, a fund like mine that does, upstream, midstream services and power, our LPs, if you asked them straight up, well, where would you prefer us to put the capital? It's not going to be in the upstream. And that has implications going forward. Third, I think with any kind of private capital deal, particularly in the credit side, you kind of have to look forward to where you're getting your money back, right? And, when we started our business 6 years ago, we were almost distinctly a bridge fund for companies that were migrating towards a traditional conforming reserve-based loan and or a sale to a bigger company. And I think if you had to predict those exits today, those are as difficult today to predict as they've ever been, right, in terms of bridging to those two markets. And then finally, I think we all have to think about where the capital is coming from. So a lot of funds have the ability to recycle money When we get paid back on good loans we've made today is unclear, and new funds, raising those are difficult just because not just sort of overall industry sentiment, but when are we going to be able to get on planes again? When can we fly to all our LPs and sit down face to face to talk about what's going on? So a lot of challenges to prying capital out of our funds these days.
So, Chris, when you listen to what Arthur was going through, which is seemingly, if that proposal goes through, it will increase bank lending to the space, or at least not let it decrease further. Is that good for what you do because some of your things you can bridge to that type of lending, or is that bad because it's competitive with some of the capital you might provide?
Well, first, I think it's always helpful to have fair dealing in regulation, because you can certainly see political influence kind of ripple through things from time to time. And that was definitely the case in some guidance that came down at the end of the last administration. But I don't think that that's what's causing the difficulty in getting banks to lend. I think it's more, really just changes in how the M&A market has happened and what that means for borrowing-based methodologies. For 40 years, a 65% advance rate on PDP value discounted at 9 or 10% was a pretty safe bet. It was really hard to lose money doing that, particularly when you reevaluated that every 6 months. But if you make a bunch of loans like that, and then suddenly the market starts valuing stuff at PV 25 and gives no value for PUDs, there's not much you can do about it. And if you have to get out of the loan, you're going to take a loss, right? Those losses are what's causing the unwillingness to lend, not really any particular ESG pressures or political agendas, from what I can tell.
Do you think, though, and I presume this might be many in industry might say that, what starts in the Arctic could end up in other places, because there's a logic to, I don't want you doing this, and that could spread. At least I'm guessing some people would offer that explanation.
No, it's definitely a phenomenon. If you look at the decision of, say, Natixis, for example, not to pick on them, but they're still in the offshore lending business, right? They'll lend to deep water developments, foreign and domestic. They just won't lend to shale onshore, right? That is a definitive decision that they've made that has some pressure politically from their constituents, shareholders and regulators and whatnot. But to your question as to whether it opens a door for me or gives some tailwinds, I would prefer the banks to be lending, smartly, correctly, and at a healthy pace, because I'm never really competing with the $100 to $2 to $3 to $1 billion revolvers that you'd put together for a public company. I'm pre that anyway. So I'd much rather see big, healthy companies have access to capital so they can grow and do M&A deals and take us out.
So, Chris, let me ask you the same question we had for Jason, which is the perfect candidate that you would be so excited to give some capital to. What type of energy company, what type of fossil fuel related energy company might that look like right now?
Well, sure. So we see really no resistance from LPs around any kind of infrastructure investments. So midstream development, whether it be even, things that touch the wellhead, like gathering and processing, all the way through, storage and even downstream applications. Also, we have a thing that we like to lend to, we call sort of infrastructure services. So whether it be pipeline maintenance, T&D maintenance, port maintenance, things like that are all things we like to look at. In addition to oil field infrastructure. That's the easy answer. I think in the upstream, though, where we're focused is on, discrete financing. And I would say not really in a drill co format, which is, I think, much more equity-like, but where we can ring fence a specific pool of wells, 8, 10, 12 wells that are going to get financed with our capital, where there is no ability to reinvest that cash. It's got to come back to the lender first. And you can really sort of hone in on, where single well economics becomes relevant again from an underwriting standpoint, as opposed to getting countermingled with, maybe exploratory drilling or G&A or other expenses that can clog up the cash flow.
I think this is the thing that we keep running into in the space is, seemingly you can take some money and go drill a well, a reasonable average well, and you can make 15 or 20% on your money. And Mike kicked us off today by showing us interest rates are low and they're going to go lower. And here we have an industry starved for capital that seems to make good cash on cash returns. Does anybody think we're going to see, a big influx of capital from anywhere that's prepared to drill these wells because they're really good cash on cash returns? Are we going to go back to family offices and foreign companies and, a bunch of sources of capital that don't care about ESG per se, or they're not ruled by it? I'm just curious if anyone has a reaction to that observation.
Yeah, from my perspective, I don't think, no is the answer. I mean, I think we're hoping to find a contrarian pool of capital that can allow us to really take advantage of the opportunity that the regulators and the banks are handing to us. But it isn't easy to come by. To your point on cash returns, I think that's correct. But I do think it's a smaller subset of assets that will attract that capital. And it may be conventional assets that attract that capital because, when you combine G&A burn and, the small scale of some of these things, you can drill, 4 good wells and 1 bad one and still have an issue. So it's really going to be case by case specific in terms of where people are willing to put capital to work. And my guess it'll be much closer to the wellhead than on a total corporate basis.
Arthur, one question for you in that unintended consequences angle we were pursuing before. There have been some banks that have left the oil and gas lending business, right? Is there something about that provision that as a bank you would look at it and say, you know what? I think what I'll do is just exit lending to oil and gas in its entirety rather than face this kind of regulatory scrutiny. Is that a possible outcome as you think about this? Because that would obviously not be good.
That's a good question. I think it would go back to what I said before in terms of how if the rule becomes final, how it is carried out in practice. I think if you did have a heavy, that is a danger whenever there's too heavy a supervisory approach, that people will say, well, we will just get out of this one particular industry and we're not really discriminating. We just are doing this for cost reasons. So I think it would depend on how it would be enforced. Okay.
Well, let's make a couple more stops. And Colin, I'll give you a warning. I'm going to ask you to, at the end, give us a 30-second summary of what you've heard here today. But Kevin Lockhart, you're in our capital markets advisory business. In particular, you were going to talk a little bit about public debt today. The public debt markets have seemed really healthy, but I don't want to steal your thunder. Tell us what you think.
Yeah, thanks, Maynard. And I've got a few pages that if they can be put up, we can go through pretty quickly. Just to set the stage a little bit, and then I'll talk about some key themes at the end. And actually, Maynard, I'll get to some of the things you're asking about what the companies can look like that are getting financed. Very quickly, in terms of setting the background, you see here the volumes in both the investment grade on the left debt markets and the high yield debt markets. They're both setting all-time records. So, the bottom line is that gets to the point that we've all read about and we've been speaking a little bit about is, monetary policy, Fed policy that is making, money cheap. And quite frankly, people also need it. One of the reasons that you see 2020 being such a spike is both, the availability of the capital in these two markets, but also, people have sort of rushed, maybe a little bit less now, but certainly in the first half of the year, due to COVID, they were kind of rushing to the till to get as much cash as they could for liquidity. So the markets clearly supported them in doing that. in terms of looking at the energy bond levels specifically and the new issuance levels, you see the investment grade side, which has had a record year. And then on the high yield side, a little bit of a different story. It's been a relatively strong year in terms of 2020 when you compare it, let's say, to 2019. But the makeup of that has been a little bit different. And we'll see that when we take a look at some of the recent issues. And what I mean by that is the makeup has been a little bit on the sort of double B side or high single B side. Then the next page, you see yield comparison, and looking at first on the left, the high yield market, and then on the right, the energy market. So these are the yields of the indices themselves. And you see in the case of both the high yield market and the energy market spikes around the same time. So they have kind of tracked one another. And that's to be expected a little bit because those are overall large economic impacts that have created that. Particularly in the case, of course, of 2020, where you saw a spike both in the high yield index and in the energy index. The energy one, however, did set a record for the energy market at almost 24% is where it peaked. But the good news is that it's improved significantly from where it was, but it hasn't tracked all the way back down to where the high yield market is. And you see the high yield market at a record level of 4.3%. So the good thing for the energy market is that the overall high yield market is strong and those yields have come down, and that is going to generally help. The next page.
Hey, Kevin, before we leave that page, can I just ask you on the right, that is energy high yield. So this is high yield to high yield. Okay. Yes,
high yield. So it's the overall high yield index on the left, and then just looking at the energy names, the energy high yield issuers and those yields. Yeah, and those are existing issuers. So the next page, just taking a look at two components. One is looking at basically the spread comparison of the energy index versus the high yield index. And this is one of the things that we take a look at, and I know investors look at when they think about what do they want to be paid when they buy an energy credit. And this is where you've seen some of the similar spikes that we saw on the prior page in terms of timing. But unfortunately, this is one of the challenges right now in the energy world and going to the high yield market. Back in the 2010s through basically 2015, there was essentially zero and actually a few times when energy was experiencing even a benefit. So there was a negative spread. So it was even cheaper in a way to go to the energy market than energy deal than it was for the overall high yield. Now we see it at 207 basis points. So clearly much improved relative to where we were at the beginning of the year. So that's the good news, but still, reasonably wide versus the average. If you look at the average over 20 years, it's actually zero. So that 207 is a relatively large number. Down at the bottom, that's actually energy as a percentage of the S&P 500. And the reason I throw that in there, you're probably thinking, well, Kevin, you're supposed to talk about the public credit markets. What are you doing putting in something related to equity in there? We put that in there because credit investors do care about the equity cushion in the deals that they buy. And this is unfortunately one of the challenges that's related to, and I'll talk a little bit about it on the key themes. This is one of the challenges in the, facing an energy high yield issuer today is just how the equities overall have tracked. The next page, and not to sound like a downer, but on the default side, this is something really important to track. While I mentioned that there's some good news in terms of some of the yields and some of the spreads are tightening between energy and high yield, we're still seeing energy default. So these are the default rates for energy high yield issuers, and we're seeing that right now at a record high. Even when if you look down at the bottom, the two lines where you see the high yield with energy, which is the 7.3%, and then the X energy 3.1, that is showing sort of the impact that the energy names are having on the overall market when you think about default rates. So this is something just to watch. Hopefully this is something that is peaking and about to come down. but an important thing to keep track of. The next couple of pages, I just want to talk about recent transactions and just show that, first of all, there's been a good level of activity. The first page, we've got the E&P side, and the good news there, I'll just pick out one name on November 20th, a credit called Double Eagle Energy. The reason I'm picking that out is that was the only single B inaugural issuer in 2020 so far. But I'm saying that not necessarily to highlight a negative, but to actually highlight a positive, which is it was actually able to get done. So this is, when I say inaugural, I mean a first-time issuer to the high yield market. So you could argue that the bar is going to be highest for the first-time issuer, and that was able to get done in a single B. What generally, if you look down the list, you'll see most of the deals done this year have been in the double B world. And what was it, before Maynard asks, they'll say, what was it that made that deal possible? It was sort of a combination of maybe four things. One was high quality Permian acreage, EBITDA size that is relatively hefty, so it's in the $400 million range, low leverage, and strong asset coverage. So those were the things that made that possible. But a good sign or positive sign is that you saw a single B first-time issuer done at the end of the year when the entire year did not have one. You look at the next page quickly, this is broken up based on midstream and OFS transactions. And I guess the first message there is the fact that we can sort of put these two on one page shows that there hasn't been quite as much activity in these markets. However, in the case of the midstream, it's certainly much better than on the OFS side. And the final point that I would make on these pages is if you look at the column, and it's a little bit hard to see, but if you look at the column underneath as of 27 November, you'll see that the bid prices are almost all above par. So in the case of E&P and midstream, all of the issuers pretty close, but certainly a very large percentage of the issuers that were in the market this year are now trading above par. That's a very good sign in terms of access for additional issuers as you look at the market. OFS is a very different story. In the 4 or 5 deals you see down at the bottom of the page, that's actually the entirety of the transactions that were done in the OFS segment or space this year in the high yield market. And 3 of those that were done are trading at significantly distressed levels. So the message in terms of where is it possible to, it's really actually the E&P and the midstream side. We think that there's the access. So the next page, I'll finish off here, maybe spend a couple more minutes, but talk about really the key themes for energy markets to access the debt, energy companies, to access the debt market. So first of all, overall credit market conditions, they are good now. We expect them to continue to be good, but the kinds of things, whether it's Fed policy, the overall market fundamentals, what's going on with inflation, with labor, employment, et cetera, and of course a vaccine, those are the things that we all hope continue to be positive. The next point is unprecedented bifurcation. That's the graph that I showed you that referred to the spread differential between the high yield market overall and the energy related market, as well as, quite frankly, also between just investment grade and high yield. So there's some of these pretty significant bifurcations that are going on that I'd like to see contract, and that's going to be an important thing to watch. The next one is flight to quality. That's part of what explains the significant gap in sort of the investment grade side and the volumes versus high yield is investors. One of the ways they're approaching the energy sector is to say, I'll continue to invest, but I want to really move towards quality. And that's whether a higher credit rating or a higher quality segment within the energy sector. So what are the things, just very quickly, I'll go off the sheet for a second. What are the things in the E&P side that I think we would like to see for an investor to access the high yield market? It's strong liquidity, large scale, low leverage, low cost structure, and well hedged. On the midstream side, that's also low leverage, low capex, long-term contracts, with high quality counterparties, fee-based, and therefore limited commodity risk. So though when you look at, yeah, mate, yep.
Well, I was going to say, unfortunately, sometimes when you describe those things, those are the people that don't need money. I'm teasing you.
Understood. There is that. I mean, that's my point about flight to quality is unfortunately that is one of the dynamics in the market today for sure.
And maybe I just ask you, Kevin, because we're running a little long. Is there anything you'd hit as we start the rest of that page? Anything you want to emphasize as we move towards wrapping up?
Yeah, the thing I would just emphasize is refinancing risk, and that is something that all investors need to get a higher degree of confidence around each company's ability to refinance its maturities today. And where you see bonds that are trading at either distressed or challenging levels, it's usually because investors are concerned about jumping into that investment when they don't know if, let's say in 23 or 24, the company will be able to refinance its capital structure. So I think that's a key thing to try and give investors confidence on, if there's any way that you can. The next one, finally, in commodity prices, what I'm hearing from investors is that they would like to see, and not that they can wish it, but what they're kind of either waiting for or focused on is $50 plus oil price for some sustained period to give them confidence. Finally, I would just say, the markets are, basically wide open on the investment grade side for energy issuers, and very much open for high quality, high yield issuers, and happy to work with anyone to think about approaching the markets.
All right, that was great. Thank you, Kevin. Well, look, I think we're going to wrap up. I was going to, Craig, I think we could do a whole segment on the Department of Labor saying you need to be careful about letting retirement funds go into ESG mandated funds. So let us come back to you on that, unless you want to take 20 seconds and add any color there.
No, I think you're right, and it's along the lines of what Arthur and Shala were talking about as far as regulators getting involved. The Department of Labor did come out with a rule. They finalized the rule. They actually did it on a short period as well. And it was designed to create some restrictions around use of ESG in ERISA covered pension funds. And so, I think everybody's touched on ESG here, and it is going to continue to be part of the debate around how access is granted and accorded.
I mean, at this pace, I feel like my children will be giving me a personal ESG rating within a few years. Like it's an unstoppable force. Colin, what's the 30-second summary of everything you've heard today?
So I'd say going backwards, Kevin reminded us that energy markets, oil and gas in particular, are still cyclical. We can see that in, unfortunately, the default rates, and we can also see it in the equity valuations. But of course, being cyclical and being at this moment in time implies strongly of what lies ahead. So that's at least one silver lining. Jason and Chris also echoed that point on pretty big, important differences on size and segment. So if you're nursing some losses in an existing portfolio, that's going to, of course, be an important consideration on capital formation going forward. But there still is opportunity for markets to, provide some love to companies that are able to perform. The Gibson Dunn team showed us a point also that Chris made, that it's not necessarily politics, but there is politics here. And be careful what you wish for. If you read Paris only as hydrocarbons equal fuel, you're going to quickly get yourself as a bank into a spot that not only is not smart, but may actually trigger a huge backlash. And arguably, we're already seeing that with the government shutdown of restaurants and small businesses. As we get today, the first effective vaccine being applied in the UK to a woman who is 90 years old. As we look at risk, this was the slide I gave, the combination of an effective vaccine going to the aged and just the unfortunate surge in the case count is moving us towards some form of herd immunity, which focuses the demand side on the calculation of where supply is in the instantaneous markets, bringing us back to where Mike started us, that we are beginning to see inflationary pressures with the avalanche of money that has been put into markets beginning to show up as sheer asset price inflation in Bitcoin, silver, copper, gold, perhaps not yet in the energy markets, but it's strongly implied that we should be looking for it.
All right, that was great. Well, let me end by thanking Arthur and Shala and Chris and Jason and Kevin, and of course our usuals in Colin and Mike and Craig. And I also want to thank the Petroleum Club of Houston. They let me do our show here today. And I think what better place to talk about access to capital for oil and gas than the Petroleum Club of Houston. So thanks, everybody, and we'll talk to you soon.